Now we're going to go deeper into U.S. products and what are some of the drivers behind, where do we think this could go over the next few weeks, especially as we get some positivity in terms of new case count, new hospitalizations, all of those moving in a positive trajectory. And what is that going to do for just overall demand? Now, before we go into it, please, like, share, subscribe. The support is appreciated. Now, when we look at 2021 versus 2020, you can see that 2020 started at that low and the weakness, and here we're seeing some of this normalcy. So what is the offset? So we had this big drive up in diesel, which is a positive. We had that move up in jet, which will come back. So here we think that diesel and jet will start to come down a bit. Gasoline will get a little bit of a snapback. But net, we continue to think that 13.3 to 13.5 is going to make that, that right number over the next few weeks. So the current is at 13.557 million barrels a day in demand versus last week, which was 13.193. So again, we're getting some of that normalcy back. We're seeing some of that, but just given where we see jet, where we see disti kind of shaking out overall, that'll start to flatline, come lower. Gasoline will maintain that 8.1 or so, and that's going to flatten us out at these levels as we go through the remainder, not only just of January, but also as we head into Feb. We continue to see some of this flatlining, at these lows. But it's just the drivers are going to be different each time, and gasoline is gonna normalize in some of these levels. And now that we're starting to get some comfort in terms of supply chain, some debottlenecking in some spots, that'll help offset some of this disti demand. And then obviously weather is going to play a bigger role over the near term in terms of heating, which remains fairly flattish in general. We've had a move in natural gas prices. We've seen some of this priced in and movements through the system. And then again, that's going to be that ebb and flow. So just getting into a bit more detail. So when we look at distillate in general, we had a draw of 820,000 barrels. We're still about 18 million over the year-over-year, 11, almost 12 million over the 5-year average. So there's still a lot of work to do to bring this down. And you can see that we've essentially flatlined at these levels, which is really what we've been talking about, where there's enough positivity, there's enough tailwinds to offset some of the headwinds that we're seeing, and headwinds really being the import numbers. So the imports remain elevated. They're still starting to slow down. We're still seeing those slowdowns coming out of Europe into the U.S. It just, there's a timing delay because it takes, several almost a little over a week, almost 2 weeks to get from point A to point B. So we have stuff coming in, then it has to wait in line to offload. So we're going to continue to see some of the slowdown. But as we said previously, even though we'll see a decline in, say, PADD 1, there's still going to be enough to see some of the elevated year-over-year, 5-year, again, keeping us within this level. And then when we look at, what are refiners doing, we continue to see kind of this shift away from producing disti or trying to minimize the distillate cut and trying to maximize the gasoline cut. And when we look at the Colonial Pipeline, which moves product from the coast up into PADD 1, we see that they're trying to get rid of some of their winter grade gasoline. And there's been a big focus from the perspective of refiners to really increase some of that gasoline cut as we continue to see a movement of blending components, because blending components, even though they're still down year over year on storage, they're still elevated in comparison to gasoline in general. So again, this is where we kind of get this push and pull when we're thinking about where is the focus going to be. Disti still remains elevated, and as jet fuel demand weakens, kerosene is going to find its way into the distillate pool, which will keep some of the storage elevated, which is why you don't really need to maximize that production. Instead, focus on the gasoline side, and then you can put your kerosene into distillate. Then you can also utilize this to make some octane. Again, there's ways to kind of massage this in different levels to try to maximize yield while mitigating some of the slowdown that we might see. And again, this was why we think some of that West African crude could find its way into the U.S., just given based on how the cracks are looking in general. So then when we talk about distillate, we were expecting another shift higher in distillate demand. We just thought it was going to come in closer to that 5-year average. Instead, it blew right through it, coming into this top. Again, it's still seasonally directionally correct. It's just the move was exasperated to the upside. We think it'll now pull back, but it won't come all the way back. Again, it'll just come back to that 5-year average because there's enough of those tailwinds to keep us pretty firm along the 5-year average in general. So as we talked about, there's a lot of peaks and valleys with these demand numbers because they are calculated numbers. So this is something that, again, it'll work its way out to pretty much work through and average out to that 5-year average in general. And the reason why, this is our trucking demand. We pared back a little bit again from 111 to about 105, 106. And it's still within what we've been saying, that 105 to 115. That's where we see that demand overall. So it's still going to be very elevated in comparison to previous years, but it will be off those peaks that we saw in 2020, and the beginning of 2021. So that's why we think we'll continue to hang right on these levels, so that we'll still see elevated trucking movements, just given the bottlenecks still persist. There's still need for moving stuff through the system. It's not as dire as it was before, especially as we got into, coming out of COVID, coming out of the first lockdown, coming out of, that restocking that we've seen, which as we get some buffer in those supply chains, then you can wait a little bit longer to get those rail cars to your market, because obviously rail cars are going to be moving, those rail trains are going to be moving 100, 125, 150 car loads, where trucks are moving 1 or 2. So again, it's a cost benefit. There's just, in terms of sheer size. And that's where we're seeing in terms of rates. So rates are starting to come down. We saw refrigerated truck rates, starting to normalize. This will stabilize at these levels, just given what we've seen on the on the refrigerated demand. But again, truck availability is kind of flatlining. You have load availability, coming back a little bit. So again, we're starting to see some of this moving off the road, moving onto rail, but still elevated. So again, this is going to be that tailwind that we're going to continue to see for the trucking side and inherently diesel demand in general. But diesel, these guys are filling up at the station. So it comes to, in terms of refilling. So we see the refilling action. We saw a huge drawdown, then you refill, and then you see that ebb and flow that we talk about in gasoline. We also get that in diesel. Now, when we shift a bit to rail traffic, so total car loads are still down about 0.7% in general, year to date about 1.4%. Chem's still elevated. That's something that will start to flatline in general, and just in terms of where chemical demand is. Grains, we just got another number. China's pulling more soybeans, pulling more corn, more wheat. Again, grain is going to continue to surprise to the upside. But as we said last week, it wasn't going to be at 40%. It was going to be something closer to 20%. Here it's coming in at about 25% year over year. That's going to continue. The versus 2020, we're still at that 39%. That's something that'll work its way a little bit further down, closer to, I think, what we're thinking about, that 25-30% average. Still huge demand for hopper cars. Still demand that's going to be outpacing 2020. So again, that's going to be a net positive. All of the others in terms of petroleum products, non-metallic, that's stuff that we think is going to continue to be disappointing in the outset. Then when we start to see some easier comps as we get closer to when the lockdowns happen in 2020, when we start to see some of the movements. The biggest driver remains total intermodal, where we had a nice gap up from about 9%, 10% to 17, 18%. That will continue, and it'll start to pare back as we head into mid-Feb. But again, there's still enough demand in the system to see some of these intermodal units, which is keeping total traffic well above 2020 at about 9%. And then as we go into the easier comps, these numbers will get bigger. So we'll just have to understand kind of where we sit in the cycle. But again, the net benefit will remain on that intermodal side. And this is something that we talked about, including weeks going forward. So you can see that we get that last surge of import volumes, TEUs, into Los Angeles as we come into Feb. But then when we get to the middle of February and what we're projecting, or what they're projecting, I should say, into the end of Feb, we're going to get this slowdown. And it's just because we're finally starting to catch up. We're starting to see some of these movements where some guys are opting to send empty cargo ships back to China to try to fix these issues. We're starting to see some of this normalization because, again, we did get a slowdown in retail demand, consumer demand, not just in the U.S., but in Europe, which didn't really happen until December. So when you think about where we looked at September through about October, mid-November, we did get that surge. So now we have to refill these supply chains, which is coming when it has really happened through December into February, and then starts to normalize as we look at the year over year. So year over year change, again, up 128%, 107%, but then only up 12%. And then when we look at change week over week, you can see that we're slowly kind of walking back to something a bit normal. And that's why that Feb moves forward is something that we think is going to be a bit more normal as we head not only into February, but into March as well. Now, shifting gears a bit and looking at gasoline. So gasoline had a build of 2.47 million. It was really driven kind of across the board for the most part, where we had some builds pretty much everywhere, and it's still tracking that seasonal norm. When you look at the seasonal builds, which normally can't maintain until about, let's call it the end of February. So there's really nothing surprising in seeing builds. The benefit remains that we're still down about 13.6 million barrels a day year over year, 5.6 million barrels over the 5-year average. The issue is going to remain, again, now that we're seeing those refiners targeting a bit more summer gasoline, we'll start to see some of these builds remain elevated, not only just on the gasoline side, but then the blending components, just because summer gasoline is different than winter gasoline in terms of what can go into it. Benzene and all of these other components will be the bigger factor. And then when we talked about imports, we highlighted that imports were going to come down a bit, still remaining fairly flattish versus last week, and they were down about 40,000 barrels. What we're seeing so far is there's going to continue to be a decline of imports over the next few weeks. That's just based on some things getting redirected away from the coast, just where some of the benefits are, especially because when we look at PADD 1 RBOB, which is that reformulated blend, that had the biggest increase of gasoline stocks of that 1.2. And when we talk about summer gasoline, we have to look at that blending components, because that's going to be the biggest tell of, how filled are we? Where is the focus? And we had a fairly large increase of 1.77 million barrels on that blending side. So again, that's going to be the one to watch to see how they're projecting and creating that summer gasoline versus others. So still below the 5-year average, which is a positive, but getting, starting to creep higher and pushing closer to it as we get more gasoline production and as we continue to see some headwinds to demand. And when we look at production at the refining side, even though refiners walked back throughput by about 0.8%, we had refiners increasing yield of gasoline by about 1.4%. So again, there's just a rejigger of the cuts and what the focus is at the cracking side and at the refinery side. So that's going to be something that will offset a bit. And we think that this is going to remain where the focus will be production within gasoline, while demand is fairly capped as we head into February. So then when we look at total product supplied, again, here's your walk back. It came down to about 7.833 million barrels a day. Again, calculated number, something to watch as we go forward. It's still down on the 5-year average. And as we look, typically we get that demand rally into March, and then we start to see some of those seasonal declines. But this is going to be something a little different, because we're going into a lull for new cases. As we've said in the economy show and in our writings, we were expecting to see a a holiday surge of COVID cases. Then people were going to ratchet down. We're going to see, people quarantining, getting a bit more cautious. That was going to lead to let's call it a February lull. And then the question is going to be, when you think about March and how people get sick during change of seasons, you're starting to get more active. You're starting to start to do more outside. This is where we could start to see another surge in March. And that's going to be one to watch and to see how we manage that. But that's a long way of saying that we feel confident that 8.1 to 8.2 million barrels a day is going to be kind of that right number, which is still above essentially where we were back when the low of 2016 to 2020 is about 8.1. We think we're just going to track the bottom of that cloud as we go through, not only just this week, but then next week and the next few weeks going forward as we progress throughout the rest of the month. Now, when we look at just kind of what's happening in general on a high frequency data side, so you can see the new cases are starting to slow. New COVID deaths had a little bit of an increase, but still down in general. Lockdown index is still elevated when we're looking at, kind of where things are shaking out on that 70, we're still above that 70%. So there's still that elevation. But when we look at restaurant bookings, when we look at airline passengers, that's going to be kind of the bigger issue as we head into the remainder of the year. And again, those headwinds that we just don't see really abating. And when we talk about headwinds, it keeps coming back to working from home. So when we look at before lockdown, we had about 18% of people working from home pre-lockdown. Then when we look at the height of the pandemic, we had about, let's call it, 58% working from home. But then after the lockdown happens, we're getting these numbers at about 33 to 35%. So about double where we were previously to the pandemic. And this is something that we're going to have to look to see, how does this really factor into the future? Where are we seeing some of this normalcy, and will this become a more normal setup? And we'll talk about this in more detail when we talk about in the economy show, because there was a really good survey done about new corporations, some new startups. Are they going to have a central office? Are they going to have smaller satellite offices, or will it be fully in the cloud? And the shift into smaller local offices instead of a central location and more cloud is going to, again, not only limit the amount of people traveling, but also the distance you'll travel if you have more satellite offices, and just how is that going to look when we're talking about that long-term gasoline demand. Now, when we pull back a bit and we look at mobility and engagement, you can see that the weekdays were starting to normalize a bit. We're still not where we were in November prior to, when we look at August, September. And it's better to look at September, October, as you think about kind of that seasonal shifts that, where we are. So we're still seeing some of this recovery, but it's just not on the same level. And then when we talk about people locking themselves in a bit more and seeing this pressure of maybe quarantining a bit after seeing family, that's where we're looking at the weekends, where people are doing a little bit less on the weekends, staying in, trying to mitigate some of the spread. So while the weekdays we think is going to stay flattish at these levels, we think that that spike in demand is going to be more on the weekend piece, where you're starting to see people doing a little bit more on weekends, driving a bit more on weekends. So that's going to be that delta between, over the next few weeks as the weekdays continue to disappoint, as we do have less people going to the office. And I think a big focus is going to look at, okay, well, when we talk about Europe and sending imports and sending exports into the world, this is, I think, an interesting backdrop of where some of these demand factors are in this economic activity versus virus deaths. So deaths is the last end of it. So we saw a dip in cases, then we see a dip in hospitalizations, then we see a dip in deaths, and we're just not seeing that dip, and that'll be say that this kind of peak is over and we're starting to see that normalization. But when we look at just economic activity, you can just see where we're sitting, where in the U.S. there's some positivity, there's some bullish news in terms of economic data points, and then there's some bearish news that's offsetting that a bit, and we'll talk about that more in segments 2 and 3 of the economy show. And then when we look at the number of, again, this is just looking at activity, we continue to see this kind of normalization at these lower levels from the grocery, pharmacy, retail, recreation, coming back to that weekend slowdown, and then just workplace and transit is pretty much normalized. But when you look at that workplace transit, we think that there's going to be a little bit more of these headwinds to the downside, just as we look at that day versus weekend movements and engagement. And that's why we remain cautious on gasoline demand normalizing to different levels, just given where those factors sit. Now, according to Pay with Gas Buddy, Saturday gasoline demand had that rise of 6.2%. Again, kind of confirming what we've been talking about, what some of the other data points have been saying. So that closed out Sunday to Saturday with demand rising about 1.44% versus the prior week. Again, which is closer to where we were right before Thanksgiving. And then when we look at Descartes, so Descartes is saying that U.S. gasoline demand increased 1.2%, very close to that 1.4%. Which is putting us at demand at about 8.48 million barrels a day. Again, we think it's lower than that. There's always going to be that calculation because, again, all of these are calculations, estimates. We think it's something closer to 8.1, 8.2, still above where we were, but again, a bit more cautious as we see this balancing act kind of leveling off at these levels. So we think this past week is going to be more indicative on Gas Buddy data and Descartes data as kind of where we'll hang out over the next few weeks. Now, exports are going to be a little bit of a headwind. We're going to see a bit more imports just in general, versus where the demand is. And again, imports will be down, but elevated based on demand factors. So that'll keep us kind of capped at these levels, which we see going forward. And then Apple's confirming a bit what we've been saying with this steady state. The U.S. being right below that 5%, Germany, Italy, UK being down about anywhere from 25 to 35%, which is something that we think is going to be pretty consistent with some talk or at least more extensions in Europe on those lockdowns. This is just showing what we were talking about, daily tests rolling over, daily cases falling pretty hard. Now hospitalizations, we did get a little bit of a spike in deaths. That's something that we expect to roll back over now that you have less tests because less people feel sick. And then if less people feel sick, then if there's less cases, then there's less need for contact tracing, which means less tests. People coming out of the hospital. Again, all of these moving in the right direction with deaths which will start to roll over. The question is going to be, can we maintain this through a potential spike in Feb and the end of February into March, just based on kind of those seasonal norms that we have? Net change in cases remain pretty steady on the worldwide side, with Europe being fairly sticky again, which is why we keep talking about, how do we see some of these adjustments? Asia Pacific is seeing an increase, specifically in Malaysia and some of these other Southeast Asian nations. India continuing in the right direction in terms of those case changes. Japan had a little bit of a spike. South Korea had a little bit of a spike. Again, trying to see where some of this is going to go as we have some increases in Asia, again, capping some of that demand in general. Then when we look at COVID vaccinations, there's continuing to be concerns. AstraZeneca is talking about less cases going into Europe. Germany wants to withhold exports until their people are vaccinated or they start to true up the numbers that they were promised instead of others. This is, again, coming to the supply chain inherently. There will be problems. We're getting a change in policy where you don't have to wait 2.5 to 3 weeks. You can wait 6 to 12 weeks for the second dosage. Now they're saying that you don't have to use the same brand where at first they did. Again, there's a lot of concerns about who's going to be able to get that second dose as they're trying to rush to give everybody the first dose. So these numbers will continue to trend higher, but it's really who has achieved their second allotment, and that's going to be kind of that deviating point of how have we hit herd immunity. And when we look at jet fuel, as we were saying before, we were going to get a little bit of a bounce in jet fuel builds. Again, it increased about 2.16 million barrels. We're still below the year over year, still below the 5-year average. We're going to close that gap quickly, just because demand, as we were saying, we were going to get a lower high, and now we're just going to hang out within this 950 to 1.2 level in terms of demand, because the factors are very weak. And when we look at the weakness, another 50, pretty much 1150 fewer departures on average each week. A large part of it, or most of it, coming from China. Again, slowdowns in terms of activity. We'll talk about that in the next segment as well. Around 1,800 flights on average per day in February have been removed, and then another 1,200 in March. Again, this is why we continue to see this continuation of weakness in the jet market, which is going to put more product in the disti pool instead of the kerosene pool, because this is not something we see snapping back anytime soon. Biden came out the other day saying that we were going to increase restrictions on international flights. We're going to increase restrictions on domestic flights. If you leave the country, it's going to be very hard for you to come back. You need negative tests. So again, all of these things are just going to mitigate, near-term travel, not only internationally, but actually more domestically this time around, which was something that we expect to see coming into the domestic market. So we were typically saying between 550 and 850. We're going to shift that down based on the new data that came out from Biden, and we think it's going to be now closer from about that 500 to about 750. Well, taking the bottom end down a bit, but again, we just think it's going to cap the upside a bit more. So shifting it to down a few percentage points, and you can see that there's something similar that we saw in 2019. Again, as we started to see some COVID problems and people maybe deterred, leaving some of their travel for another day. Again, this is going to be more pressure to the downside as we look at what that average is going to be through through March. And this is something why we think there's going to be a much bigger problem as we look at jet demand recovery through not only just Q1, but then into Q2. Now, when we talk about seated diners on OpenTable, we're back with pretty much within this comfort range of this, not much to change overall, and that's being confirmed again by OpenTable regional breakdown. Australia crushing it, putting up goose eggs in terms of contagion. But when we look at Mexico, who's saw another big increase in cases, U.S. is again at that 50 to 55 range on the weekends. Let's call it 60 to 65 on average on the weekdays. This is just going to continue to weigh. Germany lockdown, Ireland, UK, all of that will keep that global number down, and just see that slower capacity and just those headwinds into the economy as we look at not only just gasoline demand, diesel demand. And again, this is why we think we're starting to get to this balancing act as we get some of that recovery and now some of those shortfalls. And now that we kind of talk about the U.S., we have to look at, okay, well, where is product abroad and where are things overall in terms of not only demand, but also storage levels in the international arena?